Hey everyone, welcome back to Corporate Decoder. Today, we're diving into Interface Inc.'s latest 8K filing, and trust me, it's not just carpets and tiles this time. We're going to uncover how they're navigating a complex financial landscape, dealing with past cyber setbacks, and what it all means for the future of this flooring giant. It's a story of recovery, adaptation, and a bit of financial maneuvering. Let's set the stage. This report is dated February 25, 2025, giving us a snapshot of Interface's performance and significant events leading up to that point. Think of it as their official report card. This isn't just any document, it's a Form 8K, a current report. Companies use these to tell investors about major events, things that could really change how you see the business. In this case, it's all about their latest financial results. For those who aren't familiar, Interface Inc. is a global flooring company known for its carpet tiles and other sustainable flooring solutions. They've been around for decades, and their stock ticker is TILE, like the things on your floor. The most important part of this report is buried under Item 2.02, Results of Operations and Financial Condition. This section gets into the nitty-gritty details of how Interface performed financially. We're talking about sales, profits, and all those other juicy numbers that tell us how well the business is doing. We're getting a look at their financial results for the fourth quarter and the entire year of 2024. This means we can see not just how they finished the year, but also get an overall picture of their performance. Now here's where it gets a little tricky. Interface, like many companies, uses what are called non-GAAP financial measures. Basically, they're tweaking the numbers a bit to give investors a clearer picture, or at least that's the idea. These non-GAAP measures include things like adjusted earnings per share, adjusted net income, and adjusted operating income. They're adjusted because the company is taking out certain things that they think are unusual or don't really reflect how the business is doing day to day. So what exactly are they taking out? Well, it includes things like costs related to buying another company called Nora, the impact of a cyber attack they experienced, and expenses for restructuring, which means changing the way the company is organized. They're also adjusting their gross profit. That's the money they make from sales after deducting the cost of making those products by removing the Nora acquisition costs and the costs from the cyber event. They also talk about currency-neutral sales, which is a way of looking at how their sales are doing without the ups and downs of different countries' money. It helps to see the real sales performance. Interface is also highlighting their net debt and adjusted EBITDA, which is basically earnings before interest, taxes, depreciation, and amortization. Adjusted EBITDA is a common way for companies to show their underlying profitability. They say they do this because they don't buy other companies all the time, so they want to show their normal operations. The company claims that it helps investors understand how the company is trending. Moving on, there's Item 7.01, Regulation FD Disclosure. This is about making sure everyone gets important information at the same time. The company is presenting a slide presentation for investors. This presentation is what management might use when talking to investors. It could give more details and context around the numbers we just talked about. The slide presentation is dated February 2025, the same date as this report. This makes it easy to tie the two together. Finally, there are the signatures. This shows that the report has been officially approved by company leaders. The report is signed by Bruce A. Hausman, Chief Financial Officer of Interface. Now, let's step back and really analyze what's going on here. Interface is trying to show investors that despite some challenges like the cyber event, the company is still strong. They're using these adjusted numbers to paint a picture of a healthy, growing business. However, these non-GAAP numbers always deserve a bit of scrutiny. While they can be helpful, it's important to remember that they're not the whole story. Investors should always look at the GAAP numbers, the standard accounting numbers, as well to get a complete view. The fact that Interface is focusing on adjusted results suggests they want to highlight their underlying performance, removing what they see as temporary or unusual impacts. This isn't necessarily a bad thing, but it does mean you need to dig a little deeper to understand the real trends. What's their direction and where do they go next? On the strengths side, the company is clearly working to overcome the cyber event and manage its expenses through restructuring. The focus on currency-neutral sales also suggests they are committed to transparency. On the other hand, the reliance on adjusted numbers could be seen as a weakness because it might hide some underlying issues. Investors need to watch how the company manages its debt and how it performs in the long run. The risks here are pretty clear. A major economic downturn could hurt demand for flooring. Also, failure to fully recover from that cyber event could continue to affect the business. Overall, Interface is a company in transition. They're dealing with past challenges, but they're also working to improve their performance and focus on what they see as their core strengths. The key for investors is to look beyond the adjusted numbers and understand the real trends driving the business. Thanks for watching Corporate Decoder. If you liked this deep dive, be sure to hit that like button, leave a comment, and subscribe for more financial analysis. Until next time.